Did this start already?
Yeah.
Okay. So we'll continue with balance of payments. In the previous class, we talked about current account, which simply talks about the records of imports and exports. And we talked about balance of trade itself. But today we want to go in deep into current account itself. So we know current account measures the amount of money, the amount of goods and services in and out of the country. So the value of goods in the country or the value of goods out of the country, that's what current account measures. So that's why we have trading goods and trading services. So why do we call it trading goods? We call it trading goods because it involves visible goods, goods that are handy, like the marker, like the laptop, cars. Stop writing, please. These things are visible, you can see them. They are physical, you can see them. So the difference between physical goods that goes out of a country and comes into a country is called trading goods. Do we get trading goods, or I explain again? In current account, we have trade in goods and trade in services. For goods, these are things we can see, visible, physical, we can touch them, they are handy, we can touch them. Laptop, cars, and these things, we can see them. So we have those goods that goes out of the country and those goods that we buy into the country. So that's exports and imports. So for trading goods, I wrote, this is the value of physical and of visible exports and imports. So for visible exports, these are the values of goods sold to foreign customers. So it is export because we are selling to foreign customers. That is what export is about. Export means we have these goods, we are selling to foreigners. That is export of goods. Therefore, visible imports, these are goods we buy from foreign businesses. So goods that come from abroad down to Libya are foreign, they are imports, which are visible imports in terms of goods. Probably the marker might be from abroad, so it is visible imports. And if we produce this marker here and we sell it abroad, it is visible export. Do we get the difference between import and export here? Do we get it or not, please? There's trading goods, which is simply talking about visible, what we can see, what we can touch, physical. But when we sell abroad, it is export. When we buy from abroad, it's import. That's the difference between trading goods, exports, and imports. So we call it visible exports because we are selling outside of the country, we are selling to foreign customers, and we call it visible imports because we are buying from foreign businesses. Do we understand that, please? Do we understand, please?
Yes.
So the difference between the visible export and visible import is called balance of trade in goods. So we have balance of trade in goods, which is the difference between the export of goods and the import of goods. Any question about that? Good. Then the other side of the current account is trade in services. And when we talk about services, we're talking about intangible goods or invisible goods, goods that we cannot touch, like tourism, education, finance. These things are not handy, they are intangible. We call them services. Do we understand services here?
Yeah.
So services that we sell, the services that Libyan businesses sell abroad is called export of services. And the services that they render us from abroad is called exports of imports of services. Do you get the difference here, please? For trading services, we have exports and imports, same as goods. For export of services, it simply means we are selling our services to foreigners, which probably tourists or a Danish tourist in here, or a Nigerian tourist being here. So that is export of service. Do we understand export of services here? Any service that we render to foreigners are called export of services. Then for import of services, the Libyan going to maybe Turkey or Spain for tourism, that is import of services. Do we get import of services here? Do we understand or not, please? There's export, there's import. Export means we render services to foreign customers. Import means we are purchasing or buying services from foreign businesses. Any question about this? So the difference between export of services and import of services is called balance of trade in service. The difference between export of goods and import of goods is balance of trade in goods. But here it is service. So the difference between the export of services and import of services is called balance of trade in services. Do we get it or not? Do we get it or not, please? Any question? We've talked about current account, which has trade in goods and trade in service. For trading goods is the value of exporting goods and importing goods. For trade in services, is the value of exporting services, importing services. So the difference between exporting goods and importing goods is balance of trade in goods. And the difference between exporting services and importing services is the balance of trade in services. Any question about this?
No.
Good. Then that takes us to primary and secondary income. Not all transaction involves goods and services. Sometimes we invest abroad. So whatever we invest abroad, the return on it is called primary income. Do you get what I mean by primary income here? There's primary income, which simply means the amount of money we receive from the factors of production we loaned abroad. A Libyan here might have an investment abroad. A Libyan might have a land in Turkey. So the rent income that Libyan makes from the land he has or she has in Turkey is called primary income. Goods are not sold, services are not rendered. But for the fact that that individual, that Libyan has land abroad, it means it's making income from that. That is primary income. Do we understand primary income here? These are for factors of production: land, labor, capital, and enterprise. So a Libyan having a business abroad, at the end of the year, maybe he or she gets dividends from share of profits. So that dividend is part of primary income. Do you understand primary income here? Whatever we have in terms of factors of production that is not here, that's in abroad, but we own it. Whatever income that comes from them, they are called primary income. Do you understand primary income here? Then we have secondary income. Why do we call it secondary income? We call it secondary income because there's no output in return. So these are mostly between countries. The Libyan government might give the Turkish government money without the Turkish government, selling goods or services. So this is secondary income. Do you understand secondary income here? So here I go for primary income. I go. This represents the flow of money from loan of factors of production abroad. We know what factors of production are. The resources that help us to produce goods and services: land, labor, enterprise, and capital. If Libyans have them abroad, the return on those factors of production is called primary income. And for secondary income, I wrote, this represents the flow of money between countries without corresponding output. Nothing is sold. There was no transaction, but there's exchange, there's flow of money, or the Turkish government gives the Libyan government money, or the Libyan government gives the Somalian government money. These are flow of money. It is recorded as secondary income. Why is it secondary income? It is secondary income because there's no transaction involved. There's no output in return. Any question about this? Thank you.